You know, as a one-man business, when you prepare your account, you prepare it in accordance with GAAP, right?
Yes, sir.
What was GAAP?
Generally accepted accounting auditing principles.
Accounting auditing principles. Accepted accounting auditing principles.
Generally accepted.
I think
Accounting or auditing
it's
principles.
accounting.
It's accounting.
Yes. When you prepare it, yes, this is you prepare it in line with this. But from a tax point of view, you would have done lots of things that the tax authority will not regard as acceptable from their own point of view. Although your following was this principle. Do you get it? Now, let me give you instances. When you pick up a typical income statement, on the face of the income statement, you see dividend receipt, you will see income receipt from other investments, right? You will see other miscellaneous income. You will see lots of information. You will see lots of expenses. You will see depreciation, right? Okay. Depreciation is one of the items that the HMRC or the tax law does not really recognize. There is that thing. There is this thing that any expenditure or item that you recognize must be what? Must be strictly for business purpose, and it must satisfy all those four principles: reasonably, exclusively, necessarily, and compulsorily for business purpose. Depreciation does not fall short of that. Yes, when you acquire property, you acquire it for the business. So you are using the property or the plant and machinery for the business. Does it fall short of reasonably for? After all, you're still using it for the business purpose. The only reason why we normally disallow depreciation is because of the varieties in the calculation of depreciation. The method, various method. I think we have, I don't know, but I know of three. We have straight line method, reducing balance, and some of the year digits.
What does one get together? That's when you add everything together.
Some of the year digits. Okay.
Which one do you remember?
No, I can't remember. You want me to tell you I remember? You have various methods anyway. That's not the main thing. But one thing I just wanted to realize is we have various methods of calculating depreciation. And you can imagine, as a company, imagine you have company A, company B, company C. Using the same, what's it called? Acquire the same asset on the same day with the same estimated lifespan. Then using different methods, that means at the end of the year, they will be carrying a different value. Do you get? So the HMRC stands for, okay, in order for us to have the same method, that's for consistency purposes, you have to come up with what we call capital allowance. So normally we disregard depreciation. And what I mean by disregarding is disallowing it. Now, what this one simply means is on the face of the income statement, if you should pick up a typical income statement, you will see either net profit or profit, net profit, or profit after tax as the main thing. Okay? But if you look at these formats, the way in which we calculate or compute our income statements, our income tax liability, that format, we have different categories. We have non-savings, we have savings, we have dividend. Dividend has a separate column, but where can you find dividend? You will still find dividend as dividend income on the face of the income statement. Now, what we are interested in is, let me just put something like the non-savings. Savings. Dividend. Remember, trading profits will be here. Building society interest, bank interest, then dividend. All of these things, everything is included on the face of the income statement. But because of the fact that we have a way in which we categorize each of these items, so if you should have any of these items on the face of the income statement, you disallow it. What do I mean by disallowing or aligning? I'll let you know. I don't want to start using the word allowable or deductible so that you won't get mixed up. Okay? Now, the essence of the whole thing is what we are interested in as a tax person. We are interested in your tax affair, as in your trading affair, only your trading affair. What is your position? What you're dealing with? What are you into? You are into garri business. Yes, garri, we sell garri. Any other business, any other by the way or by the side, like selling of property, it does not come into garri business. Do you get? That one will form part of other income. And where do you have other income? Other income also comes under down savings. But not as your trading income. So all those items that shouldn't have been included, that you have included, what do you do with it? You take it out. Now there are two things that you are either adding or you are subtracting. Okay? Expenditure that you are not supposed to incur, that you are not supposed to deduct, that you've deducted. What do? You put it back. Income that is not supposed to be there, that is already there, you take it out. Now, income that you are supposed to recognize, that you've not recognized, what do? You put it back. Do you get it? What determines whether you are adding or you're subtracting is what you have or you haven't done before.
Comes in the nature of that transaction.
Yes, it's the nature of the transaction. If it is strictly for business purpose, and the expenditure is for business purpose and you incur it, what do? You leave it the way it is because you've done what you're supposed to do. Do you get it? Now, how about, there are lots of expenditure whereby they will have both the business element and private use. In that case, what do? You prorate, you time apportion. You get the one for business use and get the one for private use. Now, what determines whether you're adding or you're subtracting either the business or the private use is what has been done before. If the, let's say it's an expenses, if the expense has been incurred, that means you must have deducted the total amount. Yes. Do you get? You must have deducted the total amount. Now, you now discover that no, they say, okay, you are not supposed to deduct the total amount. Rather, you're supposed to remove the parts that is only for business use. What do? You get the one from the private use, then you have it back. It will increase your profits. Do you get? Okay. Another one is related party transactions, like couples working for one another for each other. There's that thing that you tend to pay your wife, or the husband tends to pay the wife at an higher rate. When it comes to paying salary, you want to pay her huge amounts. Do you know what? If you should pay her more, yes, more income is coming to the family, but not from that angle. From the angle of you being the owner of the business, you are reducing your income. So at the end of the day, you tend to pay an amount that is very small as your tax liability or tax payable. Now, what they recognize that these things happen. What they do is, you look at the context of the question. If it is the wife that is employing the husband, now what is the husband doing in that organization? If the nature of the job that the husband is doing in the organization warrants you paying the amount you are giving to him, and it is the official rate that you would have paid, and then you employ a third party, then you leave it the way it is. Yes, you leave it the way it is. But if you pay more than you ought to pay for two parties performing the same function, and you pay your wife more, higher, in that case, the difference will be the salary.
And the salary is going to be taken, just added back to the...
It's an expenditure. It's an income this time. What do you do?
And now the difference is going to be added back to the trading profit.
Okay, it increases.
Yes.
Yes, that's it. I don't want to talk it off on. I just want to go. Okay. That's just by the way. Now let's talk. There's what we call batches of trade, such as we have trade for contract of employment and contract for. Contract of service and contract for service. We have batches of trade. These are what you have to look out for before you can say there's what a trade. If I should ask you to define what a trade is, you tell me it's what buying and selling. Yes, you are right, but it goes beyond buying and selling. Now, the first one that I have here is the subject matter of the transactions. The subject matter of the transactions. Are the goods of the type that are normally used for trading? If yes, then you can say it's trade. If no, you can just say it's just an exchange. You can't regard it as trade. Another one is the length of period of ownership. There is that thing that a short period may indicate trading, because as the owner of the business, as a business owner, you wouldn't want to keep your stock for a very long time in the store out. We call it holding stock. You get it? So you want to keep it, produce and convert it easily into cash so that you keep the cycle and money keeps coming in. The frequency or the number of similar transactions by the same person, when you keep doing same thing and same thing over and over, it tends to do it. Trading. Okay? Supplementary work and marketing work. These are the signs of trade. Work performed on goods to make them more marketable, indicate trade, that's the marketing. The circumstances responsible for the sales. For this one, if, as we are just saying, buy this thing, though, yes, I can persuade you to buy it, but even when you don't want to buy it, when it comes to forcing you to buy, you cannot call that trading, because you are being forced into buying it. Trading should be a willing thing from both parties. Okay?
So if it's someone else to sell his father's property, maybe because father is there and there's no money, that's what we see as trade.
No, that's not as trade. Yes.
Everybody is broke and the one that might have to sell.
You don't have to sell something. You know, the circumstances that led into the person wanting to sell such thing. Okay, another one is which, if you forget any other thing, you shouldn't forget the motive. That motive, you should have that intention of profit making. And the last one, the way in which the asset sold was acquired. I think this one has to do with that forced sale. If goods are acquired deliberately, then trading is indicated. Do you get it? Not like someone, although we have some optimistic trading. Opportunistic trading. What do I mean by that? Okay, you are not into that business line. Maybe you just venture into it. Someone does. It's okay. Come and do it. It's very valuable. And before you know it, wow, this is. Okay. But don't be tired. You still early. I'll explain virtually all that we need to know concerning the adjustment. But I have one note that I need to. You see, they ask paper P6. The examiner is likely to give the tax adjusted trading profit. Did you get that?
Tax adjusted trading profit.
Yes, that's for you to. That means you will not be giving adjusted trading profit figure in question, or a trading figure that requires only a few adjustments rather than requiring a detailed calculation of the adjusted profit. Remember what I said? Yes. But that's notwithstanding, you need to know these details, all these things that have been mentioned. But that's, you see, we have formats. You see the formats there. Okay, now you have the notes.
We don't have certificate process. No.
Okay.
Sorry, from the first question.
Line is very precise.
You know it's familiar.
I don't know if it's precise. But what I think I've been able to do is those questions are what we've done in the past. Okay, where are we? I've explained all of this. This is the flow format. Can you just keep the questions going? You have to yourself.
6 questions, 6.
Well, what's that? Before we finish, we saw up to 100 questions. Before we start writing the exam. So that by the time you go to the exam, you go, I saw this question.
Amen.
Not seeing that you saw this before, but you be able to apply the
Insights and prophetic insights. You will see the question before question.
Amen.
And tell us.
Okay, that's by the way. Now if you look at this, you can see a lengthy format. Have you seen this? Pro forma. That's why the examiner, there are a lot of things to be tested rather than them asking you to do this. But one thing I want you to understand is, let's go to this. Hire or lease charges. I think that's the next thing we have under one. Now what this one simply means is that they recommend the fact that it's not all business that go out that owns cars or their property totally outright purchase. Instead of buying it outright, they tend to lease it out, lease it from companies, from other companies, and use it in their business. Now, what this one simply means is that if you should lease a car, of course, you're going to use the car for the business purpose. And for you to have removed or incur at the expense, the amount you incur as an expense is an allowable deduction, right? Now, what this one simply means is that if the car emits more than 160 kg per km, 160 kg per km, that means you have to disallow 15% of the cost of the lease price.
Because it is lease.
Yes, because it is lease. What they are invariably telling you is that if you want to lease a car, go for the one that emits below this. Do you get it?
So you can take out 15%.
Okay, so tell me the answer. Example 1.
Sorry. Is it cars in excess of this amount?
Yes.
You take out 15%
of the cost of the amount you are paying. You know, you have to pay.
List price. If I'm giving the list price, it's not going to be higher or list charge.
Yeah, it's a list charge.
List charge.
What's the cost to you as a company? It is the amount you're paying.
Yes.
Yeah, it's the cost. But you have to. Ordinarily, you are supposed, let's say, okay, I think I have an example anyway. Example 1. On January 2013, Anita had a car for 6,006 per annum. The car was used by Anita in her business throughout the year. Ordinarily, Anita should remove what? 6,006 from the book as what? As an expense. But because of the CO2 emission, we are giving the CO2 emission. The whole of our mileage was, okay, was this. Now calculate the amount to add back to profit in the adjustment of profits for the year ended 31st March, assuming this 130 is what? Let's do the B part first.
It's lower than that.
So what do?
You don't do
anything because ordinarily Anita would have deducted what? The A part, what do you do?
We take out 50% times 6,600.
Yes, then you now add that back to the expense, to the net income. You're adjusting your profits. Okay, now let's go to short lease. I think you still remember we did this when we were dealing with investment and experience. Okay, now let's look at from the landlord's point of view. If I should lease out my car or my property to you, I'm going to receive premium, right? Remember that the premium, the total amount I receive is not going to be charged for me, not the total amount. We have a way of calculating the chargeable amount on the premium. Remember that P,
yes, P, N minus 1.
yes, remember that stuff. Okay? But what would have happened? Listen up, when a person grabs a short lease on the property and that person, that is the landlord, receive a premium, this is treated as well for tax purpose as property income and partly as well capital receipt. The tenant who is granted the use of the property for the lease period pays the premium to the landlord, and in addition is usually required to pay rent. Remember this. I think we saw the question that you do both the premium and the rental just for 1 minute then. Okay? Okay. On a monthly or a quarterly basis, in the adjustment of profit computation for the tenant, the following treatment must be applied. The rent payable for the trading income purpose as what? Only and exclusively incurred. Therefore, no adjustment is required for rent. If you're paying rental, you don't have to adjust anything because it's an allowable expense. Okay? Then the amortization or depreciation of the lease is capitalized. Therefore, not allowable, it must be added back. From your own point of view, you are the one that pays the premium. You pay the premium. Ordinarily, you want to add it back everything, or you want to charge it as an expense in your book. You know that. You want to charge it as an expense in your book. So what do? Listen up. Let's say I'm the landlord, you are the tenant. This is the big man, and this is the small man. This man pays 25,000. This is the person that is receiving this money. Of course, that's why you have to use this P multiplied by 2%, N minus 1, to know the amount that will be subjected on this person. But, okay?
Well, that's an amount to the tenant. I think it needs to be over the number of years that is in the system.
That's the answer. What we're just going to do is, ordinarily, this man would have removed this. Because we say, you know what premium is? It's a lump sum that is being paid or being received for consideration of what is. Because you're just paying it once. There's that thing that you want to write it off at once. Now what they are saying is you have to add this back. Ordinarily, if you have removed it, you add it back first. Okay? Now what else do you do? You will now amortize. How do you amortize? You charge it based on the number of years. How do you do it? You get this. You get this first. That means you have to work from the landlord's point of view. You work from the landlord's point of view. Then, how many years? If it is for 5 years, you now divide this by 5. Then it is this 5 years. That means every year. Whatever you get here, you will be adding it back every year.
On the part of the landlord.
On the part of the tenants now. On the part of the landlord, this whole amount, because that's the year of receipts, that whole amount will be what?
Income.
Will be income.
And it's going to be taxable income.
It's going to be taxable income in that year from the landlord's point of view.
Yes.
But from the tenant's point of view, you are using the same figure anyway.
Yes.
You're using the same figure. From the tenant's point of view, the tenant would have deducted this as an expense.
Yes.
You know that. But we are not saying we have to disallow this. Disallowing what value would have deducted this, we have to add it back. Now the one that
reduce the profit.
It will reduce the profits.
So we need to add back your
You add it back, you know it will have reduced the profits.
Yeah.
Let's say he has 50,000 as the net profit.
And you have to pay.
Then you have deducted this. By the time you add this 25 back, it will give you what? 75. But that's notwithstanding, you have just added the whole amount. But you are allowed to do what? To charge it year based on the number of years. Let's say it is for 5 years and you have say 20,000 here. By the time you divide it, you're going to have 4. Am I right? Now, you've added 25 back. Then you will now charge 4. This 4,000 will be charged every year for the next 5 years.
But the 4,000 is taken out.
Yes.
Okay, so you add it to the 5.
You add it to the 5.
You add it by it.
Little by little.
Okay.
Okay? That's the essence of that. I think I have an illustration there too. Or example 2. Can you read this? I'm going to read the
Oh, I'm sorry. I was trying to write out the example. Basel owns, okay, calculate the adjustments coming interest analysis to make its profit for the year and then the year. Basel owns a property which is decided to lease to tenants on 1st February 2013. The lease granted was a 22-year lease to come interest higher and unincorporated business for a premium of £90,000 and got a rent of £6,000 payable in advance starting February 1st, 2014. Can we just have best? These are not okay. Can we just have best account letters of junior year? Capitalize the lease on its balance sheet. And in addition to the rent payable, cash out by administration of £2,000 against its income for the year ended. Calculate the adjustment from its rent higher for its profit for the year ended.
So what do you do? Do you understand the question now?
Basel is the landlord.
Basel is the landlord.
Yeah, because they own property. Now, the tenant is coming higher.
Okay.
Coming just higher. Now, this premium will take it out from the quarterly lease. But of course, it's going to know how many months it is.
Okay.
I don't know, you add it, sorry. What then they will go to Sabakadabra formula.
Do the formula. Do it.
Oh. But in 2013, 2014, it's just 1 month, 2 months, but it's every February, and it's said quarterly rent. Okay, quarterly rent is 6,000. So I'm going to quarterly rent times 2 by 2.
Do what you think.
Yeah, minimum.
Do the premium. Do the premium that was subjected to Basel first.
Okay. Yeah, that's what I'm doing.
I do that one first. Let's see.
I'm betting that because I added the rent.
You added rent.
Yeah, the rent. I should add the rent.
Do you know what's the difference between amortization and depreciation? Amortization and depreciation. Thank you. But they are both what? Okay, they are both forms of depreciation. Give me the premium.
90,000.
And P again. 37,800. Now, this is the amount of premium chargeable on this person, right? Okay, now, what is the amortization charge in the account before? $2,000. That's a form of depreciation that we have to disallow. Okay, that means you have to add back that figure. We add it back. 2,000. We're adding it back to, though this is an illustrative question, of course, we're adding it back to the net profit on every other thing that we've had here before. Then we have to deduct liable deductions. Less liable deduction. Now, for us to get this, we need to determine something. This is for a period of how many months? How many years? 22 years. So we need to get for 1 year. That will be the premium assessment. Divided by 22, what do you have? 373. That is it the amount that we are going to deduct?
Well, how would not do that with 2,000 anymore?
No, we are not adding 52,000. See, look at it this way. They've done their whole calculation. There are different ways. Some individual will say, okay, this thing, because I'm paying it at once, let me just write stuff. Some individual will say, okay, it's a lease, and I understand the fact that I'm paying for lease, I need to amortize it. Kind of, because I need tangible assets. So I need to amortize it, and I'm going to use 20% or 25% in form of depreciation. So remember the treatment of depreciation, we disallow it, that's the 2,000. You get it? That's the 2,000. We've disallowed allowed it by adding it back. Now we want to see the amount we are going to deduct. We've concluded this is for a whole year. But when was it granted? When was it granted?
Was granted, this granted in February.
February. Now February to 30th June 2013. How many months?
June. Very much May, June 5.
That's fine. So we have to get this. This is for a whole year. But we need just for 5 months. What do you have? $989. So this is the amount that we are going to deduct. Now every year, you know, we are doing this because of the fact that it's a short period. Next year, this is the different amount. 12 months. Okay?
Yes.
That's that. Do you understand?
Yes. Not really, but I think I'll go understand.
What's not in the way?
I'm just confused, but then I'll go and study.
Okay.
And then if I have a question, I'll come to hospital.
That's that. Now, the next one is capital allowance. Remember, I've told you the reason why we have to disallow depreciation. Now, in the place of that, we now came up with capital allowance. Okay. What's capital allowance?
That's the taxman's type of depreciation.
Yes. Taxman type of depreciation. That's the word. It's an allowance in lieu of depreciation.
And a request from lieu of depreciation. Allowance in place of depreciation.
Yes. That's what you get. That's capital allowance. Take that one. I'll be showing you some things. Go through, you see some abbreviations. AIA, W, FYA, balancing allowance, balancing charge. You are going there, don't worry. All of these are just short form. Forget that formats. Forget these formats. What determines all of this is what is the question given to you. That determine, okay, I'm going to have this, I'm not going to have this, I'll have this. Okay, now let's do AIA. That's the first one. AIA. What is AIA? Annual Investment Allowance. Annual Investment Allowance is tax free on the total costs you acquire within a year. Before now, last diet it was £25,000. Previous diet was £100,000. And this year it has been increased to £250,000. So what they simply mean is that if you should acquire a total assets, that we call it capital allowances on plant and machinery generally anyway. If you should acquire a total assets worth up to 250,000, you will be given 100% allowance.
But if you bought it, when you bought it.
What determines whether you're operating or not is the account, not where you bought, not when you acquire it. If you should acquire it a day before you hear the tax, you get 100, you get full. But what determines whether or not you get full or you get part is the accounting period you're working with. If you're working with a short period of accounting, then you have to reduce that. If you're working with a long period of accounting, you increase it. How do you reduce? How do you increase? If this is for a period of 12 months, then you say a period of 6 months, you say 250,000 multiplied by 6 divided by 12. Take it. So if it is for an 18 months period, 250,000 multiplied by 18 divided by 12. So that the figure will increase. And there's what we call written down allowance. Is that the next one? Okay, the next one is the first year allowance. First year allowance.
You're saying that any expense in excess of 250,000 units.
Okay, let me explain that. Yes, please write it down. Let me explain that. For AIA, we have a way of doing it. We say additions qualifying for AIA. Let me give you the formats.
No worry.
But I just want to say something. For AIA, this is what we do. AIA is a relief that you get. It's a relief that you get every year on the total expenditure you incur and the amount up to 250,000. But please, this 250,000 is being based on the expenditure you acquire from 1st 2013. So any expenditure you acquire prior to this date will be the previous ones.
So this one to the end of the tax year is just 3 months.
It's just 3 months.
They're going to have to prorate it to.
So don't be surprised if the examiner gives you anything for the year ended 2013. They can give you something for the year ended 2013.
But how will I going to prorate that to 50 by the
Remember we are in 2013, 2014 tax year.
Yes.
And that runs from 6/4 to 5/4, 13, 14. So you don't have any profit.
Wow.
Do you have any problem?
No, I'm saying that if the guy should cost 1st of January 2014.
1st of January 2014.
We'll prorate that to 50, isn't it?
1st of January 2014.
It does.
Backward, 1st of January 2014. The year we have started from when? No, tell me now. We have started from. So, but please, you have to go and learn how to prorate. That's
So when he gives us that date, we'll do 12 months, isn't it?
When they give me this date, you do 12 months. They give you just use 12 months straight away. 250,000 for expenditure acquired between these dates and these dates. Okay? That is that. We say additional 45 for AIA, then you list all those items. Claim your AIA. What do I mean by claiming the AIA? You claim the 250,000. If what you have here, say after all this expense, you have say 255. You claim 250. The capital amount will be somewhere here. You claim 250. Then you have 5 in excess, right? This 5, you have to transfer it to the appropriate pool. What do I mean by appropriate pool? Let's go to the next one. Appropriate pool. There's what we call the main pool. Well, we call it main pool. Additions in this pool increases the pool, while disposal reduces the pool. It's just like a basket full of orange. If you should take 2 out of it, it reduces. If you should add it to it, it increases. Adding and taking means acquisition and disposal. That's what I mean, adding and taking. And most especially, additions that qualifies for main pool always come here. They do qualify for AIA. We only have one exceptions. Irrespective of the CO2 emission of the car, cars generally does not qualify for AIA. Generally does not qualify for AIA. Okay? Now another one is FYA. FYA, that's first year allowance. First year allowance. It is basically on the model cars. It is based on model cars. This allowance is being introduced so as for the taxpayer to cultivate the habit of going for cars that emit what? A lower emission. So if you should go for cars that emit below 95 G per K, that means you get what called FYA. And what do you mean? First year allowance is 100% allowance as well, irrespective of the cost. If it is 1 billion, it is 1 billion, in as much as it doesn't emit more than 95. Do you get that? And you know what AIA, you know what FYA is. Okay, what's the next one? Okay, written down allowance. Written down allowance is not a separate allowance. It's not a separate allowance like AIA, FYA, no. Like main pool. It is just the rate at which we tax in the pool. It's the rate at which we tax in the pool. Okay? Let's say we've done this. We have 5,000. We have 5,000. And before now, we have something here. Okay, let's say this is our first year. Our first year. We don't have anything in the pool, and this is the only item that we have in the pool. We are going to have, we would have claimed 250,000 here first. And there are no other additions. Now what we do is if we say WDA, what's the written down allowance? 18% of this figure. That's what we're going to claim. 18% of that 480 or something. What's 18% of that? 900. Okay, 900. At the end of the day, let's say this is just the only transaction we have. We're going to have 250,900 as what? As our capital allowance. Now, this is the end of this tax year. Then in the subsequent year, at the beginning of the next year, we are going to start the year with something. What are we going to start the year with? With this different, right? 4,001. So what do you call this figure? We call it tax written down value. Just like balance brought forward from the previous year. We call it tax written down value.
And that's what we bring that balance brought forward.
Yes. So if in this year we now have additions again that qualify for AIA, we do the same way. Okay? Now let's go to what's the next thing? What's the next thing?
Example.
Example. example, okay, balancing adjustment. And this thing is all this ones that you have here is how to correct. If the number of years, the period you are considering, if it is 18 months, 12 months, this is how to go about it. Okay? And let me tell you, basically, for FYA, you don't time apportion FYA. Do you get it? What do I mean by time apportionment? If you are considering a period of 6 months and you acquire a car that emits just 90 pounds, 90 kg per km, you don't time apportion, you claim the total cost. You don't need to increase it or reduce it. Okay, that's that. Now let's go to no, before we move, let's do example 2. We've done example 2 now. Now let's do example 3 before we see so that we not blue. Example 3. You can prepare our account for the 7 months ended to 31st 2017. In the period, she purchased the following items for plants and machinery. Purchased office furniture in 25th May. That cost this. Office furniture. Office furniture will qualify for AIA. So I'll say additions. Qualifying for AIA. Furniture. $40,000. Factory equipment. 25. Then we are told that she has what? The tax isn't that value. Now you know what this one's doing. This is like balance brought forward from the previous year, telling us that this is not the first year that she's just starting the business. When you're just starting, you have costs. So the moment you've been in operation, you have tax written down value, tax written down value. Do you get it? Okay. Now what's the amount? 76,500. You are done. Let me know. 76,500. Okay. Now remember this period is for how many months period? Everything. The period you are considering. From the beginning. For 7 months. Okay, if you should add this, you have 65. Remember our AIA is 250,000. Yeah. Multiply by 7 over 12. What do you have? 145,833. You have 145,833. Remember, and this is the maximum. They're just telling us that okay, this whole thing can still accommodate this. So you just claim your words. The 65 as your AIA. Come here, CA, capital allowance 65. Okay? That is the end of that. But you don't leave this empty. You have to do your words. WDA. Your WDA will be 18% multiplied by 7 divided by 4. Then whatever you have, apply it on this figure. Do that for me.
And 65,000, no, times 76, have you? 8033. Double 3. Subtract it. 8033. At the end of this year, my capital allowance will be 73,038. Then the tax written down value will be 67. 7467. Now it's confirmed. Okay. 68 now.
68,467. That's how you do it. Do you know why we're doing this capital allowance? What are we doing?
So to know how much of it is back into that back to the profit.
Yes. To add back or to deduct. Remember, yes, you are taking out capital allowance. Okay. Now let's go to balancing adjustments. Balancing adjustments. For balancing adjustment, what this one simply means is that if you should have, of course, majorly, we don't only have balancing allowance, balancing charge for the pool. We only have that. The only instance where we have it is in the year of season. Because when you're seasoning up your business, you tend to sell off everything that you have, right? And at the end of the day, you now compare what you get. Now, but majorly, we normally have balancing allowance or adjustment on items that we do have keep separately. On items that we keep separately. Now, let me tell you those things that will come separately. We've done main pool, right?
Yes.
We have what we call special rate pool. I'm going to talk about special rate pool and items that will come under special rate pool. But that's not my way. That's my way. But let's talk about private use. Private use assets. You know, there are some assets that you use them both for business use and for private business. In that regard, if you should have such assets will not qualify for. Do qualify for AIA.
That's for private use.
Yes. The asset will not qualify generally. You have to keep it separate. Any asset that you use that has business element with private element, you keep it separately. Even if it's furniture, you know, ordinarily furniture to go to the main pool, but you keep it separately. Now, what we are saying is, if you have such assets here, if you don't do anything to it, no disposal, no addition, what do you do to it? It will qualify for WDA. But WDA, what kind of WDA am I going to use? Because ordinarily it's a main pool item. The WDA I'm going to use must be what? 18%. Even if it is what? A special rate item, special rate pool item, and WDA in the special rate pool is 8%. You know what I mean by WDA? That's the rating down value. It's 8%. That means I'm going to use 8% on it. Now let's go to the balancing charge or balancing allowance. You've already kept an asset separately. Let's say motor car. And let's say you have to WDB of say 20,000. Do not dispose of these assets, say 18,000. This is disposal, right? Disposal proceeds. If your disposal proceeds is less than your tax written down value or your cost, it will be cost if that is the year of acquisition, or tax written down value if it's not a year of acquisition. That is, you've acquired it before and you've been doing the normal either 18% or 8% on it. Do you get it? Okay, it will be TWD. Now, if this is lower than this, you have balancing allowance. 2,000. This allowance, you treat it as a normal thing here. The allowance will increase your what? Your capital allowance. Balancing allowance increases your what? Capital allowance. Whereas, if your disposal proceeds exceed your tax written down value or your cost, you are balancing charge. And balancing charge is a form of income. Do you get? You bought this thing, say this chair, say 20,000. You now dispose it at 25. You know, you're having a gain of what? 5,000. That 5,000 is a form of what? Income. That will have a negative effect on your capital allowance. Maybe you want to relax. You have a negative effect on your capital allowance. Let's do something to relax. 25. Now when you get here, it's not being jacket. Because it's an income, it will reduce this period. Do you get? If it is a charge, if it is allowance, you understand? This one is higher. You have an allowance will increase this. But if it's a charge, the moment it is in a bracket, it will reduce this period. Because it's an income, it will reduce this period. That is balancing allowance for you. Now let me just deal with car generally. Remember for AIA, you don't have what? Cars are not qualified for AIA. And for FYA, cars are qualified for FYA and cars that emit what below 95. Now to the pool, main pool, cars that emit above 95. At least 96 and above, but less than 130 goes to the pool. Goes to the pool. No, cars that emit above 130 goes to the special rates pool. Do you understand? Goes to the special rates pool. Now let me allow you to relax. 5 minutes. So before I come, do the example 4.
example 4%.
Very understand.
Yeah, for a single person,
Is that?
for a single person.
Okay.
No.
Change that. Those qualifying for AIA should turn it to 250,000. The last line. That's 25,000. Turn it to 250,000. Example 4, before the requirements. Listeners. Example 4.
Example doing is in a because I want to other cars.
Is that example 4?
Because the last example, example 5. Oh, sorry. I was looking for the
Let's do it together. 20. Of course, this is an illustrative question. We have our main book here. Now we have the allowance. What was the TWD in the book?
TWD mean 18,000.
18,000. So you're going to the additions for 5 for
3,000.
for AIA. It's 250,000. So you can just claim our AIA straight away.
Yes.
Okay. Now additions on qualifying for AIA. What are they?
3,000.
Is what?
3,000. I'll go to
3,000. That goes to the next book. Now we now have disposal, right? In this case, we have two things. In the year that the first Mandela sold for 23,000 on plant and machinery, which originally cost 26,000. What are we expected to do there?
If you want to take out 3,000,
You just
don't just take out 3,000.
you take 23,000 and disposal. Okay,
Yes.
you are right by virtue of trial and error. But what you will do is you opt for the lower of two, lower of cost and neutralizable value. What's the cost? 26,000. What's the sales proceed? That's the neutralizable value. That's IAS 2. So you go for this 23. Now what's the next figure of this?
20,000.
This closes.
Hang on.
This closes.
21.
Minus 23. Minus 2. This, what do you call this?
Charge.
Balancing charge. What are the balancing? You can only have balancing charge in the pool, but not balancing allowance. You can have balancing allowance at cessation. I think there's a note to that effect. At cessation. But balancing charge, you can have it in the pool. Okay? You will not claim it as balancing charge. However, I think what you have here is 21. What will be the